As a quick reminder, this is Michael Manatskanian. I'm a real estate investor and I specialize in creative financing, capital raising, and the co-living rental management strategy. It's the rent by the room strategy. What I'm going to do today is we're going to just get right into it because it's an action-packed day. Today, I'm going to focus on providing you a mini masterclass on the co-living rental management strategy. First of all, what is it? Why is it in such demand? What economic factors are leading to it? What are the shifting behaviors in people that are causing them to be more and more open to this type of rental as opposed to just a single family home that they live in themselves? Why did the numbers make sense for both people that live there as well as for us as investors? Because at the end of the day, we are investors. And why co-living makes your path to financial freedom so much quicker and so much easier, because even though there is more work involved with a rent by the room property compared to a long-term rental, you get such outsized returns and way more opportunities to invest because you're getting way higher cash flow and you're able to buy bigger, better properties in much nicer locations, giving you a massive advantage when it comes to raising capital and just your overall benefits as a real estate investor. I mean, kind of everything, right? And then next, I'm going to be talking about a really insane opportunity for us to potentially partner on deals if you're interested, called the Super Investors Co-Living Club, where we are collectively raising $1 million to then go buy at least 8 properties worth over $3 million, and you will be a co-owner of that investment for as little as $25,000 into the co-living club. So we pool the funds together, the co-living club pools the funds together, and then we partner on buying 8+ properties together, which would be awesome. So with that being said, let's just get right into it. So that's what I was talking about, the Super Investors Co-Living Club, as well as the mini masterclass on co-living. Once again, if you're just here to learn about co-living and why you think it makes sense for you, I want you to get so much value out of this and understand that we are in the perfect opportunity right now to get maximum returns when it comes to this strategy, right? As an investor, that's your goal. You don't want to be too late for the trend. You don't want to be the guy that buys Bitcoin when it's worth $100,000 already, when you could have bought it for less than $10,000. You don't want to be the person who buys short-term rentals in 2023, 2024, when you could have made a ton of money buying it before then. So let's get right into it, and I'll show you why co-living is going to dominate. As a very brief reminder, a lot of you already watching this know who I am. That's why you're watching this. But I'm Michael Manatskanian. I'm a real estate investor, but prior to that, I'm an Army veteran as well as an engineer. I'm a chemical engineer by trade. In regards to real estate investing, I've done over 100 transactions where I've either wholesaled or bird dog deals for other buyers. What that simply means is I've gotten incredibly good at figuring out what is it that buyers want to buy, people who want to buy real estate, what do they want to buy, and then finding them those great investment opportunities that they want to purchase. And I've done that a ton of times. I've done that dozens, 100+ times, if not more. In addition to that, I also own over 60 rentals for myself as buy and hold investments. The majority of my properties have been bought leveraging creative financing, raising capital to buy those deals, as well as managing them as co-living or rent by the room rentals. In the last 5 years alone, I've acquired over $22 million of real estate, and the majority, although I own in a dozen states, the majority are in the Southeast, and I do the co-living rental management strategy. Between my co-living rentals, I have over 100 co-living units, so 100 bedrooms listed as co-living as well. And in regards to capital raising, I've raised over $5 million from capital partners, private money lenders, and private money partners by offering them either really solid interest rate returns or allowing them to co-own investments with me. So with that, let's get right into it. If you remember anything, co-living, capital raising, and creative finance is really my bread and butter. It's where I specialize. This is my beautiful wife and baby girl. And I don't know if you know this about me, but I don't really care about materials. I'm very much a family-oriented man. I love my family. I love doing things in nature. It doesn't really tend to cost a lot. I do love to go and do adventures. Like I'll be rafting in Alaska for 5-6 days. We're going to be rafting down the river and like camping in the raft, catching our own fish and just hanging out, doing fun stuff like that. So I enjoy adventures, nature, but I'm really a family man, not really materials. I prefer experiences and just spending time with the ones that I love. That is why I do all of this. Right? And I know there's lots of investors who do it for a variety of reasons. For me, it's always been for myself and for my family to just enjoy our life and more importantly, enjoy our time. That is why owning real estate is so important, because it's one of the best ways to get control of your time back so that you're not forever working for someone else to make them wealthy while you just work and trade your time away for the entirety of your life. That is what I'm on a mission to do, is to help other people with that same journey, because I've done so well in that category. I've been able to do that at such a high level in communities that I'm part of, like my mentor Pace Morby Sub 2 community and our Owners Club community. And I was even awarded something called the Midas Touch Award. That doesn't mean every single investment that I touch or deal I touch turns to gold. It means that the community of 16,000 plus members voted me as the most helpful person in the community. I've impacted the most people in our community based on community vote, saying that I've helped them on their investing journey. The crazy part is I'm doing this at a much higher level even now, and this investment opportunity is one of those things, as well as the education that I try to provide literally for free. I take time out of my life to do this to help other people on their journey, because this is how committed and passionate I am at helping other people, especially when it comes to real estate investing towards financial freedom. So with that, it's enough about me. Let's talk about co-living. So to start talking about co-living, the rent by the room strategy, you need to understand, why are we in such a place where previously 50% of 30-year-olds were married and homeowners in 1950, but now we're under 15%, closer to 10%, are married and homeowners at 30 years old. Why has there been such a major shift? Well, there's a huge economic shift, and that has also led to a huge shift in people's behaviors, their consumption habits, like what they're willing to do. And this is, for better or for worse, this makes the co-living or rent by the room strategy more and more necessary. It's not just like, people are quite literally running out of options for housing. They're at the point in which either they're spending 50% or more of their monthly income, right? The people that make $75,000 or less on average are spending 30 to 50% on housing. So they work all freaking day, all day, making $20, $30, $35 an hour, work all day, then to be able to pay for the car that drives them to work, the gas and insurance that drives them to work, and the house that they get to live in as a result. And now the majority of their money is gone. That's like an endless loop. And there's a variety of reasons why we've gotten there. One of the main things is housing has become incredibly unaffordable, especially compared to the increase in wages, like the change in wage growth. So currently, there is an insane amount of shortage of homes needed for those that want a house. There's currently, depending on who you ask, between 3.8 to 5.5 million home shortage of those people that want to buy a home and can buy a home versus the number of homes available. Additionally, in some of the most key cities in our country, there's a shortage of over 1 million rental units. What has led to this? Really high interest rates. So the shift towards really high interest rates while housing prices increased. So to put it simply, housing prices were already increasing massively over the last decade plus since the recession in 08 till 2011. But more importantly, during COVID, interest rates got so low that asset values increased because there was more demand for housing, because it was a much better investment at low interest rates. Well, that completely jacked up the housing prices, in addition to lower supply of properties, massively jacked up the housing prices. And now we have really high house prices as a result of COVID. And then interest rates went from 2, 3, 4% to 6, 7, 8%. So the combination of really high housing prices and really high interest rates now, with no reason for housing prices to go down, that has led to a really unaffordable housing market, so that a ton of people that want to buy homes are not able to. In addition to that, there are less rentals as well, because who creates rentals? Yeah, sometimes it's people who have a house and they move, like they keep the house and rent it out and then buy another house. Or usually it's investors who are buying properties to then rent them out. When interest rates go up, properties no longer make sense as an investment, especially as a single family home investment. So the combination of all of those economic factors plus more, and housing prices growing so much faster than income in most major metros, housing is completely unaffordable. The simple solution in theory, government, produce more housing. Allow people, reduce restrictions, remove rental controls, make permitting quicker, allow for more dense housing, right? And that's people, that's policies, that's government, local, federal, all levels of government are making it really slow and difficult to build houses. That would be in theory what you do, but it has to make economic sense to do so. People have to be able to A, make money when they're building the house, right? And then B, the people who are buying the house have to be able to afford that house. It solve it perfectly, but in theory, make more houses if there's more demand. In reality, it's just not how it works. And we're really stuck right now with no clear solutions. Supply is tight. Demand for housing is still strong. Costs are up, but wages are stagnant, pricing a lot of people out of housing. And policy overall is broken at every single level. You and I know we're watching this, we're doing these kinds of things because we understand that government is not going to solve this problem. They never have and they never will. They only make problems worse, unfortunately. So then co-living forecast. Where's co-living currently and why is it going to continue to expand and expand even at a quicker rate than it already has, which is insane. So the current market cap as of 2024 for co-living is $7.8 billion. For those of you who don't know what that relates to in other management strategies, it's really high already, is what I'll say. It's very high, but more importantly, compared to most other management strategies like short-term, mid-term, long-term rentals, it's expanding and it's expanding at an insane rate. The rent by the room or co-living rental model is expected to grow at a compounded annual growth rate of 13.5% from 2025 to 2030. If you don't know what that means it's huge growth. There is huge growth expected with already a big number to start with. We're not talking about a couple million. We're talking about billions of dollars, almost $8 billion in 2024, which has already rapidly grown since then from 2024 to now when this was tracked. But the growth rate is massive at 13.5% compared to any other rental strategy. Simply, huge market for it currently, and it's only going to grow at an incredibly fast rate. The thing is, people don't really understand co-living. They think of it as, why would someone ever do co-living? Why would they ever rent out a property and share common areas with someone else? Because simply the most common way to do co-living is you have a house and people share like the kitchen, a living room, outdoor space, and everyone has their own private bedrooms. Some private bedrooms have private bathrooms. Some have shared bathrooms. To people, especially investors or those that are doing better, you think, or especially if you have a family, like, how could anyone ever do that, right? Well, it's really more common than you think. Simply understanding my co-living journey will help you out. I am a byproduct and a success story of the co-living model in the sense of how I took my savings and made way more from it as a result. To start out, like everyone else, you started co-living when you lived with your family. I'm just joking, but like that is the most common sense. I don't track that as a metric, but you've already shared a house. You've already shared common areas. You've already shared bathrooms with other people, right? The difference is you were comfortable with those people. You knew those people. You grew up with them. Then for me, I went to college. When I was in college, my very first year, I shared a dorm. It was like 12 people that shared a living room and like 3 shared bathrooms. And in each of the bedrooms, there was 3 people, 2 or 3 people in every single bedroom. The next year, that was pretty sucky, right? It was bunk beds and all that stuff. I don't do any type of co-living like that. Then the next year at school, I was able to get my own apartment with 3 people, right? We each had our own bedrooms and we shared the common area and we shared the one bathroom. 3 people, individual bedrooms, shared one bathroom and the common area. This was on campus. The very next year, my wife and I moved into, or then girlfriend, but wife and I moved in together. We rented out a 2-bedroom, 2-bath property. Her and I shared our bedroom and shared a bathroom. Our roommates, 2 people shared one room and then they shared a bathroom. Why did we all do that? Because it saved us a ton of money on rent. The next year, we got even smarter. I rented out a 4-bedroom, 3-bath property. My wife and I were able to live in 1 bedroom with a private bathroom. Our other roommates shared the other 2 bathrooms and 3 bedrooms. And for the most part, they covered all of the rent, right? They covered all the rent. So we were basically able to live extremely cheap, if not at points rent-free, because we were able to rent this place and then rent it out by the room to other people. But we lived in that co-living style property. When I joined the military, it went back to the freaking army days, barrack style, where there was multiple people in one room sharing common areas. And then when I bought my first ever investment, my wife and I, we lived in 1 unit. We bought a 2-unit property. We lived in 1 unit and rented out the other by the room, 3 bedrooms, 3 baths to military soldiers, like to service members. All that to be said, this is a lot more common than you think. And I didn't even think about this in the same sense because it is so much more common than you think, especially because housing prices are so expensive. I was a broke college kid who had to work a whole week before I ever started my first class just to start barely making ends meet while I was in college. I was able to get some student loans, but I got scholarships and I had to work 2 to 3 jobs at a time throughout college to be able to just barely make ends meet, including the co-living model. If I wasn't able to save on my rent, I could not have afforded to go to college, right? All that to be said, it's a lot more common than you think, especially for those that are making less than $70,000 a year. They're spending so much of their income on housing. Well, it's more and more common when people start to realize, I don't want to work all day, every day to make just enough to pay for my car, my food, my insurance, and my housing, and then I have no money to spend on anything. The younger generation has shifted their spending habits to focus more on experiences over materials. So rather limit their rental costs, right? And increase their spending on eating out, traveling, or those who did it kind of the way that I did it, to take that money, save it, invest it instead on their path, right? It was a huge part of me being able to invest money, pay off all my debts, and then shift to real estate investing. And then now I raise capital. So it's kind of irrelevant, but it was such a big part of my journey. People are realizing they'd rather spend less on housing, less on all this other crap. They have to still have a very comfortable, safe, and private room. Yeah, sure, share common areas, but if you're working all day anyway, like, you tend to veg out in your room anyway. So whatever. In addition to that, short-term rentals are very popular, and the government started cracking down on it. Similarly, as the economy gets worse, people have less money to spend on vacations and travel, especially high-end vacation and travels. So between ordinances and economic conditions, there are less and less short-term rentals that are successful. Either the government is locking them up or like restricting it, or there's just less spending towards that category. Well, it's the exact opposite when it comes to co-living. When the economy is doing worse, people tend to want to save on housing. They spend less on discretionary spending on purses and travel and this and that. But people still need housing, so they're looking to save money. This is something that you notice commonly. When the economy does worse, people stop renting or buying houses, but apartment rents go up, right? The amount of people renting apartments goes up because it's a cheaper alternative to renting a full house or buying a house. It's a very common trend. Similarly with co-living, it benefits from a worse economy. Am I saying I want a bad economy? Of course not. That's also a reality, especially as the supply and demand of housing, supply is still too low compared to the demand. Housing prices continue to increase. There's less and less rentals available, and people are just making less over time. So then for us as an investor, right? Like, I do this model above everything else. I'm very transparent about it. I love that this investment strategy helps solve the affordable housing crisis, right? And it's only going to get worse in our country. It is better that people like us solve this problem because the government won't, and we really don't want major corporations and BlackRock and those guys to try to do it because they tend to make it as terrible as possible to maximize their profit. It is much better for us as mom and pop investors, people who have a handful of or no properties and trying to buy their first few, handful of properties, dozens of properties, even me at 100 plus, right? The goal is 100 to 200 in total. That's still nothing compared to when a corporation can buy hundreds, thousands in one foul swoop. Worst part is using our 401k money. So that's kind of the worst part of it all. It's better that people like us do it. And on top of that, it is the key investment strategy for people like us in general, because we're able to buy more properties. We're able to buy larger properties. We're able to buy them in better markets. When you buy bigger, better properties in nicer markets, you get more ownership benefits. You get more appreciation because you're buying in a better market and the property's already worth more. You get better debt pay down. Your tenants are paying larger amounts of debts on your behalf. Both of these add to your net worth every single month. They're building your equity for you. Additionally, you get more tax benefits because the properties are worth more, and you're doing renovations, which also is a tax write-off. And more importantly, you get much higher cash flow. Cash flow is your profit at the end of each month. The more cash flow you have, the less income you have coming in to cover your expenses. Once your cash flow exceeds your expenses, you are financially free. You never have to work again for someone else, exchange your time for money ever again, because now your money is being generated passively through your portfolio. You still have to work a couple hours a month, but you have a lot of ultimate flexibility, which is incredible. And you get way outsized returns for the amount of effort that you put in at that point, because you put in most of your effort up front. So once again, I don't want to act like some kind of hero because I'm focusing on the co-living model. Some people do, and I get it. It's great for their marketing. It's good PR. I don't care. It's true. We get to provide that solution. But at the end of the day, the reason why co-living is phenomenal and continue to grow, especially for investors, is because it has way outsized returns for investors. Like the returns are way higher. You're able to buy bigger, better properties and get way more cash flow. You're able to be financially free more quickly with less properties, with less headaches as a result of the co-living model. And what I put here is ideal tenants. For me, there's all types of tenants. You can focus on students, you can focus on military, you can focus on all types of things. I don't really pigeonhole. What I do is I focus primarily on working professionals, people who are making 20 to up to $40,000 a year are typically the main candidates for my properties. Typically that $25 to $35 an hour. I can't force that, right? You can't force that, but that's kind of what I've seen, what I've observed with the properties that we're buying and the way that we are managing them. That's the main demographic of people that are living in our properties. This is just a point into perspective. The median household income, 50% of people make less than $80,000 a year. Median household income makes less than $80,000 a year. And that's not insulated in major cities as well. That's still an issue in major cities as well. So with that being said, 50% of the people fall in that category. 50% of the workers out there fall in that category. This is not some small problem that we're solving it for literally half the country. And those that think people that are making $100,000 a year is like anyone, that's not true. Close to 20% of people make over $100,000 a year. Those that are investors have unrealistic expectations of what the normal person is typically going through. I'm telling you, 50% of people make $80,000 or less. And that's the main demographic for the co-living model. And that is only going to grow and grow because, as you know, your $80,000 income or $60,000 income, whatever, meant a lot more 5 years ago than it means now because everything costs way freaking more. So inflation has tore up your ability to acquire things, buy things, rent things because everything has gone up in value where your wages have not substantially. So that $80,000 today versus 5 years ago, not even comparable compared to how much everything has gone up in value. So with that, let's continue. So I hope I made the case for housing unaffordability as a whole and how it's only going to continue down this route and if not massively increase, especially based on the projections right here. Why co-living is such a need and who it primarily benefits, how it makes really solid returns for us as investors as well. So that at the end of the day, and I said this the other day, we're not all Jeff Bezos. We're not Bruce Wayne. We don't have billions of dollars to just throw it for charity, right? If we're going to do something like this, it tends to be because we also get something in return. I can't just build 100 houses or 1,000 houses and just give them away for people to live in and rent out. That'd be a cool dream. I'd love to get to that point where I have enough money to do so. But us as investors, us and others need solid returns to do these types of investments. That's why it's so important that this also has really great investor returns because then we're able to solve the problem. In a capitalistic economy, we have to get something in return for that. The more we get, the more likely people are going to do this. That's the idea of how capitalism solves problems, right? In theory. Then we have government and all these other things that make it way worse. All right, why co-living is big, the shifting demographics, why it will continue to grow, and why it's got solid returns for us. I'm going to keep diving down into that. What you see here, it's probably small for you to see, is the map of a platform called PadSplit. They're the #1 provider of rent by the room housing in our country. And this map really shows you where are the core areas they are currently operating in blue, where are they expanding to in gray. And what I will tell you is 2 years ago, when I started on this platform, I don't even know if there was even 10% of these dots on there. And then even a couple months ago, I did a similar presentation, there was substantially less dots on there as well. And now there's more, and there's going to be more and more and more and more. It is the golden opportunity for those that are investors that want to provide this solid affordable housing, make an impact, will also get really great returns. Now is literally your chance to do so before you regret not doing it sooner. I think we'll still have plenty of demand over the next 5, 10 plus years because nothing's going to solve this problem besides us, that you can still come in. But the later you come in, like any investment, the worse the returns are for you and the more competition you're dealing with and the higher the price you have to pay for everything, right? Because of all those things. So co-living, let me make the case very simply for why co-living is better than just renting out the same property by the room, how it has much larger returns than renting out the same house to one family. This was around a three bath property in Atlanta, Georgia, that would rent for around $2,000 a month, right? $1,995 a month. You pay your maintenance, you put money aside in reserves for maintenance, you have no utilities, your tenants cover all that, and then you pay 10% of this rental income, roughly, right? Just rounded it, towards property management. Well, that nets you around $1,600 a month of revenue. Well, that doesn't account for things like your debt, your vacancy, because the property's not going to be full all the time. This property that you could rent for around $2,000 a month starts losing you money every single month because it doesn't, once you account for the debt and vacancies, that property is no longer profitable. There is no cash flow. That same property, yes, adding 5 extra bedrooms, making it an 8-bedroom, 3-bath property, now can rent in total for $65.50 a month. You set aside $400 a month in maintenance, so 2 times the amount you were saving as a long-term rental. The roof and all that stuff won't need to be replaced any faster, but you're going to have more, plumbers go out, electricians, little things like that, service done to it. You'd save a smaller percentage, but it ends up being a much larger dollar amount. You cover the utilities for the property. You pay your property management fee. That then ends up netting you $4,600 a month, roughly, right? That net, you pay the same debt, roughly $2,000, vacancy and all that good stuff. And that property starts generating you around $2,000 a month in cash flow. Same property that was going to lose you money is now generating you $2,000 plus a month in cash flow. You need how many of those to become financially free? For some, 1, 2, 3, 4, 5. You get 10 of those, you got $20,000 a month coming in through cash flow, while your properties are also bigger, better, nicer properties, building you wealth, debt pay down, appreciation, tax benefits. So this income is also tax-free. It's the cheat code. It is the most accessible path to anyone who's watching this right now to become financially free. Could you say you could have invested in Bitcoin earlier and all that? Yeah, you could have gambled and got lucky. I did some of that too. Thankful that I was able to, right? However, the person I am who's very much more analytical and don't like to take unnecessary risks or gamble, it's really about what makes sense by the numbers. This is the most obvious path by the numbers, right? And it's accessible to a ton of people, especially right now. But you have to know what you're doing. That's the hardest part. I'm not going to say co-living rentals is easy to rent out as a single family home. It's not. That's not true. It takes more because you have more people in the house. That's why you pay more for management and understand there's going to be potentially more issues, right? But you get way outsized returns. The same property that make you no money or even $100, you get 10, 20 times that same amount of return on the same property after all the expenses are accounted for. It's insane. This is just an example of a property I own. Can't guarantee this on every single investment because I also buy leveraging creative financing. So I get lower down payments and lower interest rates. That's another advantage of working with me. And I'll talk about that. Here's another property that we have, a 7-bed, 3-bath property in Atlanta. This property, once again, similarly would have made around $2,000 a month, but now makes $5,700 a month as a rent by the room property. I'm showing you here the exact floor plan. This one is way tighter than most of my properties. It's 1,633 square feet for 7-bed, 3-bath. What that means is there's no living room. There's nothing like that. There's a smaller kitchen, but there are 2 laundry rooms, a kitchenette, a full kitchen still, and then a big outdoor space and great parking for this house. I don't like to do properties this size, this square footage for this many rooms. I like it a little bit bigger, but we do not compromise on the quality of any of the bedrooms. There's no room that is less than 100 square feet, right? The smallest one is 100 square feet right here. This primary bedroom has an additional entryway. This one has an additional entryway. It's a really solid place, and the bed to bath ratio is 7 people share 3 bathrooms. So it's around 2 people per bathroom. So I'm not compromising on some of the things that I think are the most important, bedroom size, and the things that cause issues, right? Like the bedrooms are spaced out really well. There's very few that share walls, just right here, a little bit right here with the closet. So we have closets to minimize some of that. And the way the beds are set up, they're bigger bedrooms. We're not cramming too many people in a bathroom, although this is a smaller square footage than I like. Nonetheless, this exact same property is bringing over $5,700 a month of income. That's great for us as owners, as investors. But more importantly, in this market, someone's going to have to pay $1,200 to $1,500 a month for a 1-bedroom, while instead they're able to pay $174 to $206 a week. So on the highest end, they're paying around $800, $850 a month. On the lowest end, they're paying somewhere in the sevens. So why would they do this? Well, they get to save $500, $600, $700 a month, and their utilities are included, and they get a private bedroom, share a bathroom with 1, maybe 2 other people, get a solid kitchen space, and they get to use that money to do whatever else they want in life. Are you seeing why people would do this and why it makes sense for people to do this? This property was 100% occupied within 30 days. Just to show you, that's not always the case, right? In Atlanta, usually only 80% of the property is occupied in 30 days. This property, because it was renovated so well and my team's really solid their operations, we're able to get it rented out 100% in 30 days. People always ask me, can I understand? Can I see an example? Can I see numbers for tenants, for you, the property layout? I'm giving it all to you. Things people charge thousands of dollars for, I'm giving to you for free right now. So to quickly recap, why is co-living the best rental strategy for any single family home property, right? Any house. Why is it the best strategy? You get way higher cash flow. You're able to make, this says 2 to 5x your returns. I'm being conservative. The same long-term rental could lose money or even make only $100. We're making $1,000, $1,500, $2,000 plus dollars on a single property. Your returns are massively higher, massively. You're also investing more to renovate and furnish your property, right? So you have more entry costs. So your cash on cash return, I won't get too far into the weeds, but that increases typically 5, 10+% than what it would as a long-term rental, even with a larger investment. But more importantly, your cash flow, which is what makes you free, is substantially higher. So that means you need less properties to become financially free, which means you can also do it faster, which is huge forever. Some people don't care. They'll take 40 years and they'll do it, whatever. That was never my goal. There's a reason why I got to $20+ million of real estate in less than 5 years. My goal was to get there as quickly but as efficiently as possible and do it safely. Like, I'm not a get rich quick guy. I'm not trying to gamble and take unnecessary risks. However, when you find a great investment opportunity, you need to capitalize on it. And once it works really well, there's no reason to not continue scaling that. Okay. Higher appreciation, because these properties are in better markets and they're better properties. They appreciate more. They increase in value more because the market is better and the property is better. Because the debts are larger on these properties, because I can cash flow substantially on a $300,000, $400,000 property compared to, $80,000 to $100,000 properties, which most long-term rentals are looking for. These larger debts, my tenants are paying down my larger debts for me, adding more to my net worth every single month, on top of more cash flow, on top of better appreciation. And because the properties are worth more and we're renovating them, there's even more tax benefits. So all this cash flow that I get is tax-free. It's the freaking cheat code. By the numbers, it's the cheat code. As a bonus, we also get to solve the affordable housing crisis, or at least we get to be a contributor to helping that out, right? Because people say, well, aren't you taking housing from those that could buy it? That's not true, because a ton of people cannot afford to buy houses. I can't be the one to solve that. How could I do that? I can't contribute to that. And people cannot afford to buy the houses because of interest rates and housing prices. So it's really not making a big difference, because a lot of these people cannot qualify for $400,000, $300,000, $400,000 or more properties because of their income, because their credit, whatever. But at least now they get more housing options. Well, then aren't you taking rentals away from those that want to just rent out a full house? Sure. But instead of housing one person in a house, we're able to house multiple people in one house, allowing more people to get affordable housing. You see how there's kind of a trade-off between the two. You can't say, oh, the negative, but not the positive, right? That's a big part of it. So now I gave you the little mini masterclass on the co-living buy box. Now, or the co-living, right, as a whole, why the economy is the way that it is and has shifted, made it way harder for people to survive, acquire properties, acquire rentals, why co-living is already large and will continue to increase massively, and the finances of, as an investor, why does it make sense to go the co-living route? Well, right now I'm doing something extremely unique, something I've never done before. Usually what I do is I have a property and I say, hey, capital partner, this is the property, these are the terms. Do you want to partner with me on this deal? You bring the $100,000, $125,000. I'll give you 40, 45% of the ownership, or 30 to 50% of the ownership, and we own this property together, right? Or if I've raised money in smaller amounts from people, I have the deals already to go. This one's different. We're doing, instead, to make it as educational, as worthwhile as possible for those looking to grow and scale in this arena. Instead, we are pre-raising $1 million total. People can enter that joint co-living buy box, right? Join that for as little as $25,000. What that will then allow us to do collectively as co-owners is go ahead and buy 8 or more co-living rentals worth over $3 million. Those are projections. Anticipating an average property value of around $400,000 based on my own portfolio. The 3 to 450 range is kind of where we'll be at. Anticipating we're going to use around $125,000 of the $1 million for every property we buy, so we get to 8. In all honesty, I tend to buy properties closer to $100,000. So if we're able to buy 9, 10, awesome. But I don't want to overstate and underdeliver. I don't want to overpromise and underdeliver. Because I'm doing that, I'm also giving up more of the ownership to make it worthwhile, even with my conservative estimates. These funds are going to be used to acquire, renovate, furnish, and reserve to generate at least 15% cash-on-cash return and 30% total return on investment. Every single property individually will meet that criteria and be in a core market, core pad split, core co-living market for us to decide is it even worthwhile for us to invest in this? The goal within 12 months, use those funds, ideally less than 12 months, acquire those 8 properties totaling at least 64 rooms, right? Or close to 64 rooms. Some will be 7 bedrooms, some will be 9 or 10 bedrooms, some will be 8. These are estimates. And we project, because there's a 15% cash on cash return of the per property that we buy, I project around $150,000 or more of total cash flow. Some of our properties are going to generate much higher than 15%. We just bought some that are 20, 26%, right? So it just depends on what's available at that time. We're going to hold these properties for 5 years. And then at the end of 5 years, we'll decide as individuals and collectively, which properties do we want to keep, refinance and pull money out and give money back, and sell. We'll decide at that 5-year mark, property by property, what do we want to do with each of those assets. Some will keep, some will refinance and pay back the capital. Some will sell and then pay back the capital, and we move on from those investments, and you got to learn along the way. The reason why this investment opportunity is so sick is not just the investment returns, but it's because instead of me saying, hey, here's the deal, bring me the money, let's partner on it, this investment opportunity is phenomenal for those that are looking to actually do this at a higher level for themselves. If your goal is to become financially free through co-living, right, through co-living rentals or even rentals in general, this is your cheat code. This is your fast track to getting the credibility you need, the knowledge and education that you need, because instead of just saying, hey, here's the investment, you want to partner on it, A, you get to come in with way lower capital, $25K minimum, as opposed to 100 plus like our usual capital raises. And you have co-ownership, and you don't just have co-ownership of a property, you have co-ownership of a multi-million-dollar portfolio with multiple properties totaling 60 plus rooms. You get to learn through each of those experiences. And because there's a co-living club, like a co-living club, we're not just saying these are the deals we're buying. I'm presenting the analysis. My team and I are getting the deals, analyzing them. If you want to be part of that, you can be, presenting the deals to our club. And then we vote collectively, which properties will we acquire? Actually, I say we vote. I actually can't vote. You guys vote on the deals that we're going to buy, and it's going to require a majority to say which deals we want to buy. So you're literally part of the process of choosing the properties that you're investing in, and you're diversifying because you're putting in only 25K minimum to then be able to acquire this, be part of this portfolio, and have decision-making on this massive portfolio. There's literally nowhere else you can do this. I don't even know of such a thing where there's any other opportunities to do something like this. People have only done it the way that I've done it, which is have the deal, raise the money after the fact. Because we're raising the money before, you get to learn as part of the entire process. If you choose to, you can still be a passive investor and get solid returns and all that. But if you want to be more active, you have the ability to do so. You have the co-ownership, the hands-on experience, the real-life education, and the massive credibility boost. Because imagine if you're trying to buy deals or you're trying to raise money for deals, who would someone rather work with? The person who has no experiences in starting out, or the person who has, even if it's co-ownership, multiple millions of dollars of properties and multiple properties under their belt? It's not even a comparison, right? And if you think that is the same thing for someone with no experience, no knowledge, nothing, to be able to raise money, as opposed to someone who's done the thing or has experience, has properties, it's just not even comparable. Like it's just not. It's way easier once you have a portfolio. That's why real estate investing becomes easier and easier with time. So you're building your portfolio, your credibility, all of that stuff, and your knowledge, and you get that opportunity through an investment like this for as little as $25,000. What we're providing our capital partners is a 45% equity split. All of our capital partners will own 45% of the portfolio collectively. That already is solid returns in the sense of we put in the money, it's $1 million to then acquire over $3 million of real estate. Well, that's already a higher number than the $1 million, right? The 45% is already higher than the $1 million. Secondarily, you also get cash flow, solid cash on cash return. You get all the ownership benefits as well. We're projecting over a 6.8% cash on cash return and 20% average ROI. I obviously can't guarantee anything, but those are the projections. And then for every $25,000 investment, you get 2.5% of this total capital partner split, right? That's what of the $1 million, you get 2.5% of the ownership of that. It's a little complicated, but it really isn't in the grand scheme. It's just a few numbers you multiply. Very simple and easy. Once again, 3 options at exit: keep, refinance, sell. So another big bonus that I've added is I'm doing a co-living workshop in San Diego, a 2-day all-intensive workshop. How to find deals, choose your market, how to choose your market, find deals, analyze those deals, and everything you need for the co-living model to succeed. I'm doing a 2-day workshop in San Diego. Every investor that invests at least $50,000 will get a free ticket to that. If you cannot make it in September, no worries. You will get all of the recordings. You'll get all the tools, resources, templates that I'm providing to everyone there so that you have the most solid foundation. So if your goal is to do this, you have ownership, you have returns, you have all this education, you have all of this stuff to massively fast track your ability to grow and scale your own portfolio. There is no better cheat code than this. I can't even think of anything. I wish I had these opportunities when I started out, but this wasn't realistic. This wasn't a thing. This type of thing was held only to accredited investors, people who have over $1 million net worth or are making hundreds of thousands of dollars a year, right? And that's where most of my capital is raised for most of my investments. I do things like this to help everyone out. Yes, you need to have savings to invest in this, obviously, right? You're investing in this, you get all this ownership. However, there's nothing comparable, especially at this price point, especially for who I can help serve with this strategy. All right. Obviously, there's risks involved with all types of investing. Zoning and regulatory risks, right? There's occupancy rules that say, hey, you can't have more than 6 non-familial people sharing a house, right? Or whatever it is. It depends on the state level, local level, municipalities. It just depends. However, most locations have either started looking a blind eye to that, or have actually redacted or removed or replaced that language to make this more and more accessible because they know this is a true solution. So as long as you're setting up your properties while you're taking care of your tenants, as long as you're doing the normal things that you should be doing, especially in my opinion, if you're doing an investment strategy that makes you a ton of money, you should also be taking care of your people. Because you are getting more return, you should be a good steward of that money, not just for yourself, but you take care of the people that you're providing housing for. When you have more capital, you're able to do that. Because if you don't, if you have $100 a month coming in, you can't solve and fix everything. When you got $1,000+ a month coming in, you can make sure that house is at a much better level for your tenants. And they like that. So the zoning and regulatory risks are pretty much minimized. Obviously, it's still a reality because there's still language in a variety of locations. However, everything is shifting in the right direction with major states, cities redacting or replacing that language. For example, Colorado, Washington, Oregon, California has made affordable housing more accessible and building more. Montana, various parts of Texas. There are still places that are not totally cool with or that haven't changed their language, but they're looking a blind eye to it. There are still some that are not cool with it. Well, it's fine. Don't invest in those markets. Screw them. If they don't want to make this easy for us as investors, well, then what can we do? I'm not going to fight them. There's plenty of other places we can make this work successfully, and that is what we'll do. Unfortunately, to the people that live there. There's financing challenges in theory because traditional lenders get a new loan on the property. They have to underwrite the property and see what the property is worth and what they think you can make in rental income on the property to give you a loan. Well, most of them are not accounting for co-living income. They only account for long-term rental income, which would mean it is harder to get a loan on the property. More and more lenders are now accounting for co-living income to provide you a loan. More importantly, all this is irrelevant because I buy all of my properties leveraging creative financing. I don't go to banks. I buy through existing loans like subject to. I buy seller financing, so the sellers are my bank, or a combination of the two. So none of this stuff even matters. When it will matter is if we choose to refinance out of these properties, but there are already more and more co-living lenders that do co-living loans, and it's only going to massively grow and scale over the next 5 years where those refinances would even become relevant. Diluted returns is a risk. So if it takes a very long time to acquire the portfolio, well, that money's sitting and it's waiting for those investments to be acquired, so then it starts generating returns. Cool. Well, luckily for you, I'm the cheat code for that. It's literally what I do for other people. I do that for myself. I buy multiple properties a month and have bought multiple properties a month for quite a while and help other people buy tons of properties. Plus, I have an army working on my behalf in regards to my super investors community, my wealth to real estate community. That's over 1,500 people who would actively bring deals in exchange for a fee, right? They're doing it as a service. They're getting paid for that, but there's no shortage of investment opportunities. Plus, I'm a leader in Pace Morby, my mentors, Sub 2 community, Owners Club. There is no shortage of great investment opportunities for co-living that are creatively financed. There's no shortage of that. So we can get those we can acquire those right away. The only limiting factor is, in my opinion, it is never a good idea to buy more properties at one time than you can effectively renovate, furnish, and operate in a timely fashion. If you are trying to do all 12 or all 8 properties at 1 month, well, that's going to lead to operational issues causing more problems. You're going to end up paying more for carrying costs, renovations, all these things, or you're going to lose sight of how your project should be performing. So I think realistically, between the first 6 to 12 months, we will get all 8 properties, if not much sooner. And once this capital is ready, we're going to buy 2, maybe up to 4 properties instantly. So within the first month, we'll have that many properties right away. There's no shortage of that. And having the money already ready to go also makes us more competitive to be able to buy deals compared to someone else who has to wait a few weeks and raise capital and all that, saying we have the money, let's deploy it. That makes us more competitive to buy the best deals more quickly. Other risk is we have 6, 7, 8, 9 people that don't know each other living in the same house. More tenants, more turnover, potentially more late payments, more roommate conflicts, more management headaches. Luckily for you, you don't even have to worry about that. My team and I handle that between property management, boots on the ground, and just our overall operational team. You have the right systems and management in place. You're able to minimize those headaches, but it's still a risk. It still happens. There's more management involved with it. That's not a burden you have to worry about as part of this opportunity. Additionally, market saturation risks. I say that, and I say that kind of in jest. In theory, as more and more people get into this, there's going to be more of this housing available. There's going to be more competitive. Like, we're so at the beginning stages of this. We're at like the perfect time. There's not even a concern. And the continued demand for this type of housing is going to far outpace the continued supply of this property, investment strategy. Additionally, we have such a competitive advantage because we buy creatively financed. Most people who go take out new loans cannot make deals work for them. They're putting in too much of the down payment. They're paying way more in interest rates. We're able to get way better deals, which means we can buy more. And it's not even in comparison to the way the majority of people buy deals. So it's not only co-living is more niche down, but then buying creatively is even further niche down, that we pretty much are at the top, like at the complete way ahead of the competition in every sense when it comes to this. All right. So why would you want to do this, right? You want to understand not just for the returns, the education, the ownership, being part of decision-making, but you want to ensure that if you're doing that, you're aligning with a really solid team. And more importantly, you're aligning with a proven team with scalable systems, because your goal is to become financially free through this, right? You want to do this yourself. It's not through investing in someone else's deal. It's going to be when you can replicate this for yourself. And then you start going to raise money for your own deals to then go and buy 5, 10 plus properties using none of your own money. That's what you want to do. This is your fast track. The best way to do that is with a proven team, a scalable systems. Myself, I am very known for deal analysis, deal sourcing, and I have supercharged deal flow of creative finance. As I mentioned, through my super investors community, my wealth through real estate community, owners club, sub 2, all these other avenues, solid relationships with bird dogs, wholesalers. There is no limitation or ability to get great creatively financed deals. And I specialize in analysis. And more importantly, we're going to analyze, review together, and then vote on the ones we want to buy. So if you're concerned with that piece, great. You'll review the numbers before we buy anything. So you're part of that decision-making process. Secondarily, my asset manager and project pretty much focused primarily on project management, Leanne, she's been with me for 2 years now, and we specialize in co-living, and she specializes in renovations, furnishings, overseeing project management, which includes due diligence, so like while it's under contract, inspections, all that kind of stuff, helping that renegotiate the opportunities that we're considering buying, renovating the properties, getting good contractors, overseeing them, ordering the furnishings for the properties, laying out the design really effectively, setting it up effectively, setting up our team of local service providers, which we already have in lots of areas already. So we already have teams ready to go to take care of these assets. And she oversees our overall property management, because we do outsource property management for the most part. We leverage the Passbook platform and local property management, so people who are local to handle day-to-day operations, we deal with the highest level. Additionally, I have a really solid financial management team. I have a fractional CFO. I have a bookkeeper. I have a CPA. It's all ready to go. Everything's already set up for us to just hit the ground running when it comes to this. Additionally, because there's a capital raise through the fractional platform, then they also have their own bookkeepers, CPAs, and all that provide financial resources. So it's even bolstered, and there's more visibility on this stuff. This is 2 of the capital raises that I've done on fractional to raise over $1.2 million to acquire over 55 rental units, 55 co-living units. So this was a total of, $4.5 million of real estate. One of these was way bigger. That's why it was a larger capital raise, but way bigger. And these deals were both funded within the first 72 hours. Well, we're raising more money, so it might take longer, but it's a different strategy that should be more beneficial to more people, especially those that are learning as much as they can, building their credibility, building their portfolio, getting all this extra education, getting all the property designs and marketing material and photos to leverage in their own journey of investing, building their own credibility, so you can go and scale. I don't want you to be my partner forever unless that's what you want to do. What I really want to do is you take this opportunity and then go and grow and scale independently from me, not as a partner with me forever. I want you to do this, learn as much as you can, and then within the first 12 months, go and replicate this for yourself. Maybe it's property by property, and then you scale it a couple, like whatever it is. I want you to leverage this. That's why there's so much extra hands-on and education involved. This is what I'm offering is a worse return for me than my typical investments. The benefit, there's way more people that are going to benefit from it. We're going to have the money pre-raised to then go and buy these investments. And I get to help a lot more people, which is a big part of where I'm at in my investing journey.